Alright, hello guys, and today, in the quickest way possible, I'll be showing exactly how I trade from a top-down analysis perspective. When you come into the market, what you're looking for, what to wait for, and how to wait for it, when to strike, and all that. First, I'm going to start off on the monthly time frame. I have this theory that says when price is trending upwards, every candle should keep on seeking the previous candle's high. So, in relation to that, when we come to the monthly time frame, our draw on liquidity should be the previous month high or any liquidity that is up there in the bullish market, in a market that is going up. Now, looking at GBP USD in 1 month, alright, this candle right here is the January candle. This was the December candle. Before we got into January, this candle would have been my draw on liquidity, this high right here. But this draw on liquidity has already been met. So what next would have been our draw on liquidity? Because we are bullish, right? This high right here. Now this high has been met. What next would be our draw on liquidity? This right here. Now this high has been met. We see it is a swing high. We see it causing the rejection down. So if we are to continue seeking higher prices, what else do you think we could be drawing to in the future? We could be drawing to potentially this high, or in general this swing high. So now we have understand and we have established that we are bullish on GBP USD. Bullish means we are going up. When you drop down to the weekly time frame, all right, the same thing, the same idea. We want to see wicks, all right, keep going after the previous week candles high. All right, let's start from here. We are bullish on this market. Look at what price kept on doing. Price kept on taking the high of the previous candle. This is one candle. This is the high of the candle. This is the low of the candle. All right, in a buy candle, price opens at the lower side and closes at the higher side. All right, when I believe we are not total beginners, so we should know how candles form. Sell candles open on the higher side and closes on the lower side. Now look at the week. This week right here, it sought this week's high, and that was the draw. This week sought this week high, and that was the draw. And that's what price keeps on doing. It keeps on seeking the high of previous candle. Look at what last week did. Last week was a very bullish candle, and immediately the week opened, it continued in its move, seeking last week high over here, right? So having seen that, to establish a bias, right, we need to first determine the trend. Are we going up? Are we going down? If we are going up, then every week should keep seeking the previous week candle high. Now the only time when price now starts to retrace is in two scenarios. Number one, when price sweeps a swing high, price can use it as an excuse to start retracing, or when price creates a fair value gap. A fair value gap is a 3 pattern formation. All right, 3 candle pattern where we have the first candle, the middle candle, and the third candle. In this scenario, we have this black candle as the first candle, we have this candle as the middle candle, we have this candle as the third candle. But this market has not closed, so we don't know what if it's going to close higher, if it's going to close lower. We don't know how it's going to close until the third candle closes. Your fair value gap formation is not complete, and this strategy works around only fair value gaps. All right, the system is fair value gaps and Fibonacci. Good. So now looking at this week now that has been bullish and now rejecting, we can argue that price is rejecting after hitting this swing high right here. This swing high here was when price started rejecting. Good. Now price might want to use it as an excuse to sell. If price closes like this, today is Friday, price closes like this, next week could use this sweep and this available fair value gap as an excuse to sell down into this gap here and probably continue buying. But how would you approach the market when you come into the chart? All right, I'll delete everything and start again. When you come into the chart in a repeatable process, all you do is you can come to your monthly time frame once in a week to know what the monthly is doing, or every day if you want to. Check out the trend and check out the fair value gaps. Three things. All right, there are three things you want to do when you come into the market. Okay, you want to first on the monthly time frame check for fair value gaps and swing points. I'm going to explain this part as I go. Alright, so when I say check for fair value gaps and swing points here, this is what I mean. When you come into your market, you are marking out swing point to see what the market is trading into, because the market is usually trading into PD arrays. PD arrays mean price delivery arrays. All right, price delivery arrays. What are the two price delivery arrays that we're talking about? Swing points, as in extreme highs like this and extreme lows like this. That's what the market is usually trading towards. And what? Fair value gaps, as in the gap between three candles. This is candle 1, candle 2, candle 3. Let me mark it out so we can see it's candle 1, candle 2, candle 3. All right, these are the three things price. These are the two things price trade towards: swing points and fair value gaps. All right, price could use swing points to resume a direction. It can use fair value gaps to resume a direction. All right, so how do you mark out your fair value gaps? How do you mark out your fair value gaps? When you see a candle like this, for instance, let me first put on the vanishing box over here. Put on the vanishing box. Now let's imagine the remaining price action has not been created. We see price, this candle right here, get created. One, and then we see this candle get created. A fair value gap has not been created. Check it out. The only thing we have is this gap over here. This full gap. We only have a full gap because let's assume that other candle has not been created. All right, but eventually it gets created, and then what do we have? We have a gap. I'll use a line. We have a gap between the high of the first candle and the low of the last candle. That is a fair value gap over here. In as much as this third candle does not trade to touch the high of the first candle, it leaves this gap. That means the market is healthy. That means price will have continuous reasons to keep going. All right, this is just the monthly time frame. I'm going to go lower. Take this area as an example. We see price create this white candle first, then it falls down, creates this black candle, then that is 1, 2. This third candle now traded back to the high of this first candle over here. We can see how price created this white candle, created a low here, this black candle, and this black candle. But this black candle created a buy, an impulse that came into the low. of the first candle, which makes there to be no fair value gap in between. All right, this one, the same thing, price came back in. So everything over here like this is called a liquidity leg. When a leg or a move is void of fair value gaps, all right, when a move does not have fair value gaps in them, they are called liquidity legs. Now this has a very tiny fair value gap over here, but you can see that it is very tiny, almost invisible. All right, let me take that out. I believe you now understand the concept of fair value gaps. 3 candles, 1, 2, 3. After the third close, you will check if the first candle high and the last candle low in a bullish scenario, if they are overlapping. If it overlaps, there is no fair value gap. You are looking for a gap to be created. Good. So when you come on the monthly time frame, you mark out your swing high and your swing low. But because we are not swing traders, I'm going to simplify it to just previous months high and low. So what you do is the previous month, all right, the candle, you mark out the high and you mark out the low. These are your draws on liquidity for that month. Price will either head towards the high of the month or head towards the low of the month, all right, because it is seeking liquidity, and liquidity is always around highs and lows, swing points. Once you have done this, you've marked out highs and lows, you drop down to your weekly time frame. What are you looking for? You are looking for signatures. You are looking for, does my weekly time frame has fair value gaps that I can follow? All right. Does my weekly time frame have swing points that it is sweeping? All right. Sweeping means price comes below a low, sweeps it and rejects. I will explain that. Now, this is this week candle because the market has not closed. And then this is last week candle. Let me take out the bullish line. That's this line right here because price has already met with it. So I'm going to take it out. Now, once we have marked out the highs and low. Let us imagine we have marked out the highs and lows of the monthly candle. All right. Now, we come to the weekly and also do the same thing. We mark out the high and the low of what? Of the previous week candle, because that is where the market is likely to trade towards. It is either going to trade towards last week high and continue the move, or trade to last week high, sweep it and immediately reject. What I mean by a sweep is, imagine price bought this candle right here, came up here and then it sweeps it. They will now be having a long wick, like this tiny wick right here. That's what we'll be seeing. Like this is currently creating a wick. A wick is when price trades to a certain price point and start rejecting. It leaves a signature that I've gotten here before, but some sort of resistance made me fall back down. So it leaves something very tiny, like a tiny line. That's called a wick. Why? When it is bulky like this, it is called a body. All right. So price can either trade to that previous week high and continue. Price can trade from here and continue, or it can trade to it and fall. That's what swing points do. Swing points continue, or swing points sweeps and run. So when you come to your weekly time frame, you mark out the previous week high and low as well to know where price is likely going to trade to. But when your market is trending, like I said earlier, price will continuously seek the previous week high and continuously seek it. So now, what's going to be our next week drawn liquidity? Right? If price just closes like this, imagine if price closes like this, our next week drawn liquidity will be this previous week high. We are looking for price to come here, trade into it and continue, or sweep. All right, because if it closes like this, that means we now have a fair value gap inside here, like this. There is a gap. Look at this candle, 1, 2, 3, and there's a gap, which means price is very likely in the next coming weeks to do this and continue. All right, this could happen, or price can just open next week and continue buying as well. But for approach sake, how will you approach the market? You come on a weekly time frame, you mark out your previous week high and low like this. So after marking it out, we are looking for how to engage the market. This is where you will do your waiting, the daily time frame and the 4-hour time frame. These two time frame over here, right here, daily and 4-hour, those are the time frames you will be doing a lot of waiting. All right, so you are waiting to see if the daily time frame has a fair value gap. If it does not, wait for the fair value gap to be created. It takes 3 days for a fair value gap to be revealed on the daily time frame because it takes 3 candles. So on the daily time frame, it is going to take 3 days. And sometimes you will miss out on trades because price will not come back to fair value gaps. But that is the strategy, and you just have to follow it, right? The strategy has to do with a lot of waiting. You will have to do nothing, or you'll be taking random losses. That's why I advise you have other things you are doing. So when you are waiting for setups, you are not just on your charts glued and forcing things to happen. You will lose out a lot. You understand? So now, let me take all these out. We are on the daily time frame, so we can understand the perspective over here. Now, we have the 1, 2, 3. This is the previous fair value gap. Now, take note, when price creates a fair value gap, 1, 2, 3, there is a gap here. You can see gap 1 over here. There's a gap over here. And price does not return back to it and goes on to create another fair value gap. You are moving on. You are not waiting on that gap, right? You are moving on. You mark out this one and you are waiting for price to come. It is when price now comes into this gap, that is when you now go to your 4-hour time frame to now be positioned and be waiting for an entry or for a confirmation or for a signal. Okay, so what you are doing on the daily time frame is wait for the daily time frame to create 3 gaps to the upside if you are bullish, or a gap to the downside, which is 3 candles to the upside if you are bullish, 3 candles to the downside with a gap in the middle if you are bearish. You understand me? So you wait. Now that price has created this, I was waiting, right? But then I was able to quickly spot that price had created this as well. There's a gap here. All right, so price can easily come into this gap and bounce off of it. So when you have spot your gap, let us imagine that price has now created a fair value gap. These are not useless, so you will bound to delete them for now. You will put them into action because if this fail, price can trade deeper into these and hold. Now, when you see the fair value gap is being created on the daily, all right, you mark out your target. Wherever you engage price from, the high, this high right here, is always your target after seeing your fair value gap. Once you mark out your target, you take your Fibonacci 2. Alright, eventually you might have to pause the video and configure your Fibonacci to look like mine or to have my levels. So you draw your Fibonacci 2 this is bullish. So from a bullish scenario, you draw your Fibonacci 2. I like to draw from the key range. There are 2 ways I draw my Fibonacci. I can either draw from the key range, which is the first candle to the last candle high. But if the middle candle is higher than the last candle, you use the middle candle. I can draw from the key range, from the full range, which is the first candle right here. We are working with this fair value gap now. When we are working with this gap, we have to count from the candles that created our gap, which is this 1, 2, and this black one, 3. So let me use full range. We draw our Fibonacci from this low to this high right here, but let's draw it out. You see the line is overlapping. The line overlaps here. And what do we see? Where we want to engage price is in these 3 levels: 70.40, 79%, and 61.8. My personal best is the 70.40. But when there are reasons for price to go lower, price may go lower. So I take 79% level. After drawing your Fibonacci, very quickly, without having to confuse yourself about much, you are going to the lower time frames to look for signatures. Now, what will your signatures look like? Your signatures will look like lower time frame fair value gaps that have not been traded into. Price can come there, trade into them, and reject from them. Let us now use this as an example. Let us go lower. We go to the 4-hour time frame right over here. What do we see on the 4-hour time frame? You know, this is the daily time frame Fibonacci that we draw using the full range, right? We see price. Let us adjust this. We see price on the 4-hour time frame has a fair value gap that has not been traded into before. So we keep refining until we find the most sensitive area that price can reject from. This is 70.40% level. That's where I'm looking to enter from. Like, price should trade here and bounce, but I'm looking for a signature where I can enter and protect my stop loss. Let us go lower now to the 1-hour time frame to see if we have more reasons to refine. We go to the 1-hour time frame, and on the 1-hour time frame, what do we see? On the 1-hour time frame, we have 1, 2, 3 candle. We have an unmitigated fair value gap over here. All right, price did not tap into it. It left the gap and it's ran. Now that is my entry. I can go as low as the 15 minutes time frame or 30 minutes time frame, but when the 1-hour time frame gives me what I'm looking for, I stay there. And I'll draw my box from the opening of the fair value gap to the low of the third candle. All right, if you check here, there's also a gap here. Price can actually have reasons to come lower than here, but this 70, this blue line, is a very sensitive area, so I like to take that price. Price can also take it and fall low and lose low, but that is the market, right? When you have a strategy that works, it's not going to work 100% of the time. You can have a 60% win rate, a 50% win rate. All right, so this could be one of the trades where the strategy fails, but it's not a problem because on the next one it could win. All right, so what do we see here? After we trail down to the 1-hour time frame, we see a gap inside here. Check it out. Let me zoom into it a little bit. We see a gap that aligns with the 70.40% area or level. It is that gap I am looking to take my immediate entry from. I take a long position. I calculate my losses. And what do? I protect the third candle. Because why? I want to see price drop into this sensitive area and in the shortest period of time, all right, start to reverse without having to protect all the way over 200%. No, I don't need that. Price is looking for premium areas or discount areas to buy or sell from. So I want to see price do this, drop into here, into this area, and buy back up. I'm using current price action. So this is already a trade idea. This is already something I'm waiting for. Okay, bad as a bad. If it's going to, let me say, seek lower prices, it could do this. Sell as low as here and then reject very strongly, and that is what I'll be waiting for. Okay, so at the end of the day, how do I trade and what will you be waiting for? Like I said, on the daily time frame, you are waiting for price to create fair value gap for you, which is, you see how we have refined from this daily fair value gap down to where we could get a direct entry on the 1-hour time frame. You see that, right? That is how I trade. I can now target here the high, which is 164 pips, 1 to 6. But my basic TP is around 1 to 5. Alright, 1 to 5. But when you are right on a trend and on a position, you can be able to take the entire thing. Okay, so we are bullish on GBP USD, right? And price has created this fair value gap. We measure at our Fibonacci, it gives us 70.40% level. Now let me open the Fibonacci setting. Look at the setting, okay? These are the levels you want to turn on. 0, 0.618, 1, minus 0.27, 0.704, 0.5, 0.79, and minus 0.68. Those are just the levels you need on your Fibonacci. And then you can change the color. You can recolor it to whatever you choose or whatever you like. Those are what I use. Good. Then going lower, you can set the level. Is either percentage or value. I put my percentage, but I like to leave it as value. I recently changed to percentage because of a video. Since then I just left it at that. So back to values. Alright, it's back to values. So now there are two ways I can approach this market. I can either take an immediate buy right here, like I'm positioned already, over here. I can either take an immediate buy when price drops into this level, it tags me in and it buys. That is a buy limit. Or since this is daily time frame, I can wait, right, for price to tap. Let me take out this to tap these levels or this area, because price may not come this low. All right, don't forget that this is a fair value gap and it could cause price to reverse. Doesn't necessarily mean that price will come that low sometimes, but when I want to take an immediate entry, a limit entry, I refine the entry to a probable cost, to something lower that can bounce price. All right, so now this is the entry of the fair value gap, which is immediately price sweeps the last candle, the third candle. The fair value gap has been triggered. Let me take out this Fibonacci. All right, so immediately price sweeps this third candle over here like this. Immediately price drops into it. The fair value gap has been triggered. What will I now be waiting for? If I don't want to take a direct entry here for price to reverse, I'll be waiting for the 4-hour time frame to create a bullish fair value gap, a new bullish fair value gap on the 4-hour time frame. This means that right here I will not be taking, imagine I'm not taking a direct entry and I delete this out. What I'll be waiting for, this is the fair value gap, the gap in that daily candle. I'll be waiting for price, all right, to tap into this area, which it is doing right now. It has tapped into it, and then create new 4-hour fair value gaps to the upside in the next 4-hour candles 3 times. All right, so the next 3, I need 3 candle formation that will create a fair value gap for me to trade off of, which is about 12 hours. So now I will not be doing anything on this market. What will I be waiting for? Price to start buying back, create new 4-hour time fair value gaps to the upside that I will now measure out, just like I measured the daily, all right, with my Fibonacci. Remember that on the daily I measured out from the first candle to the last candle to the third candle, right? This third candle right here is hidden inside the high of the middle candle. So I use the middle candle's high just like that, and that is the same thing you want to do to the 4-hour time frame. When price creates that fair value gap to the upside, just imagine something like this one. When price creates that fair value gap to the upside, what you want to do is you measure from the first candle to the third candle. This is 1, this is 2, and this is 3. To the third candle high, this is the high over here. You draw it out, make sure the line is staying on the high. All right, 1, 2, 3, and using this FVG, it is on tap. Price is just getting into it for the first time with this candle. Using this FVG, we see that price where our entry is safe. That's the 0.618 level over here, which is also a sensitive area. So price can just tap into this place and reverse, or we can wait for price to create a new bullish fair value gap to the upside, just like this one over here. You draw your fib. When you draw your fair value gap, you draw your Fibonacci, you measure it, then price comes into it, it taps, you protect, you take price lower than the 79% level. You can use about 25 pips, because I like to give my trades room to breathe, about 25 to 20 pips, and you target the high. When the trend is strong and the market is in good condition, this trade should not be a problem. In about a day or two, we should be able to see the target met, or 3 days, sometimes only 1 day. You understand? I stopped trading in the lower time frame because of the losses, and the losses I keep on bagging on the lower time frame. So I had to let the lower time frames go and frame my system around the daily 4-hour, 1 hour, and 30 minutes rarely, or sometimes. You understand me? So that's basically how I trade, and you should watch the video multiple times till you understand the concept and then you can always replicate it. You look at different pairs and you keep on replicating it, and you do your own due diligence. You do some back testing of price action that has already happened, you understand, and then you check how it works, how price action works. Because if you go on the daily time frame now, and I'm supposed to show you fair value gaps that worked very quickly. Look at this one over here. Look at this fair value gap. When price created this fair value gap, this gap over here, but that one failed. What did I say you do? This one is not useless. You will wait for it. Alright. Where is your target area? Look at it. This is first candle, second candle, third candle. Target area is this high over here. So what the price do? Now let's measure the Fibonacci. This is the first candle, second candle, from the first candle to the third candle. We draw it out. What do we see price do? Price immediately came to tap the 0.74 level. And what did it do? It traded in how many days? About 1, 2, 3 days. And in 3 days, price has gotten to that high. If we were to take this trade, long position, if we were to take this trade and protect with about 25 pips, like I usually say, that's how many pips in profit? That's about 125 pips. A 1 to 4 risk to reward ratio, very clean. Even if price now eventually came back to sell off, I took this trade. I was in this trade and I used this trade to pass one of my challenges. I think phase 1. Yes, I was positioned on this trade and I won it. Alright, and I got out here. Even if price came back to sell off, that is why, except you have reasons for holding for longer period, you're looking to get out once price gets to this high. Okay, that's one scenario where the strategy worked. I don't want to get into the video so it won't be too long. That's showing multiple scenarios, but very quickly, let me use this one as another example. Look at this fair value gap right on the daily time frame. This is day 1, day 2, day 3. All right, we see price create this gap from here to here. That's the gap. But when you draw your Fibonacci, first candle to last candle high, you see that price never came back here. But what did price do? Price came into the fair value gap, if at all. And now from coming into this fair value gap, if we go to the lower time frame with 4 hour, we will see that price may have created a 4 hour fair value gap that it used. All right, since you can look at it right, since price did not come back all the way down to this place, okay, what did price then do? As price tap into just the fair value gap and continue moving up. Now let us check. As price tap into it, what are you going to wait for? You wait for new 4 hour fair value gaps to be created. Let's delete this. We delete this. Look at this. Price did not create any fair value gaps until it got here. So this is candle 1, 2, and 3. Right? 1, 2, 3. We measure out our Fibonacci from the first candle 1, 2 to the third candle. And what do we see? You see price. What did price take here? Price took the 61% level before it bought. Price took this level. Alright, I would have taken the 70.40% level, not the 61.3, because that is where I'm usually putting my stop loss. Now, if the entire range allows you to use about 25 pips in everything, you use 25 pips. If you want to risk lower, you can just protect the 79% level with about 5 pips, and you target the high, which is the 100% level. That's it. That's the 1 to 3. So imagine you took the 61.8% level. That would have been a win. Right here in this scenario, this would have been a loss, because when price came into the 70% level, it just traded, swept the low and started buying. All right, you know why it did this? Because of this accumulation. Price created too many liquidity in this area, so that purge could make price overextend. If there was no liquidity grabber here, I'm very sure this would have been a very simple tap on the 70% level and rejection. But all this liquidity and choppiness, you can see how price is ranging inside. It's just scattered here. All that messiness, price, you have to clean it by sweeping and rejecting. So on another video, I'll probably be doing another analysis on another time frame on another pair that explains the strategy. If you do this consistently, repeatedly, you'll be able to find an edge and understand what works for you by yourself. All right, this is something that I was able to come up with after numerous losses on the lower time frame. So I took my strategy from engaging on the lower time frame to engaging on the higher time frame. The sacrifice is patience. We have to wait a long time for the setup to form. Sometimes you don't need to wait a long time. Every time it forms, it will just work. It just keeps working and keeps working, and you're like, what's going on? Why sometimes you just keep missing trades, price don't come back? It doesn't mean you now start adjusting or changing your trade. The forex market has seasons. There are seasons to it, and there are seasons when you are just winning and you're just winning, and there are seasons when you win drawdown. Almost everything you do is a loss. That is when you take a break, you go and do something else, you come back to the market 1 week later when the market is balanced and sane again. And there are times you just keep missing trades, but you'll be fine. Profitability in the forex market is a long-term game. It's not something you want to get profitable in the next 2 days, in the next 1 week, in the next 1 month, when you have not put in the effort. You understand me? You need to understand how you are waiting for your system and how it plays out. You need to know when it is in a losing streak, so you can know that, okay, let me take a break so I don't lose too much till I can take another win. And that is usually how the market does. Market goes into seasonal tendencies, seasons where things work, things fail, and where you just miss trades. So picking your seasons to give the market your capital to be able to make some profit is where profitability, real profitability and professionalism lies. Alright, that'll be all for today's video. Alright, perfect. Thank you.